All right, let's talk about a real head-scratcher in the world of emerging market tech, Sea Ltd. We're going to do a deep dive into what I call the Sea paradox, centered on its financial arm, Sea Money. Now, this is a company that seems to be completely defying the laws of financial gravity. For any investor, this is what you look for, a variant perception scenario, where the numbers just look way too good to be true when you stack them up against decades of history. And this, right here, is the core question that gets the whole investigation started. I mean, how on earth can a company lending primarily to unbanked or underbanked folks in Southeast Asia blow up its loan book by 80% in a single year and somehow report almost no bad loans? It just doesn't add up. So we had to take a closer look. And here's where you really see the scale of this anomaly. Sea Money is reporting a non-performing loan ratio of just 1.1%. Now, to put that into perspective, for the last 50 years, any bank that grew this fast in an emerging market would be looking at NPLs somewhere between 4 and 8%, and that's being conservative. Sea's numbers aren't just good. They're so good they look like a typo. They're basically unheard of. And just look at the sheer speed we're dealing with. The loan book didn't just inch up, it exploded. We're talking from $5.1 billion to $9.2 billion in 1 year. That's an 80.4% jump. So how in the world are they pulling this off? Well, let's start with their side of the story. Sea's official explanation, the story they tell investors, is all built around this idea of an ecosystem moat. The concept is pretty simple. There are 3 main businesses, Garena for gaming, Shopee for e-commerce, and Sea Money for finance, aren't just separate entities. Nope. They're part of one big, deeply connected, self-reinforcing machine. They call this their full stack advantage. Because they own the whole customer experience, they can slurp up all this unique behavioral data from their gaming platform and their e-commerce giant Shopee. This lets them find new lending customers for practically nothing, which gives them this huge structural leg up. In theory, the whole thing is way, way more powerful than its individual parts. So, how does this actually work? Well, Sea Money doesn't just start throwing cash at new borrowers. They use what they call a gradual scaling model. It all starts with a tiny buy now, pay later loan for something you buy on Shopee. We're talking average loans of less than 20 bucks. Only after you prove you're reliable by paying that back do they slowly start to offer you a bigger line of credit, and then eventually actual cash loans. It's like a trust-building exercise. And this brings us to the most important piece of the puzzle, the data. This is what they claim is their informational edge. A regular bank has to rely on old, formal data, like a credit score. But Sea Money? They see what you're doing in real time. They know what you're buying, how often you pay, how reliable your delivery address is. They even look at your gaming habits. The argument is that this creates a far superior closed-loop way to figure out who's a good bet to lend to. Now, that is a very, very compelling story. But if this ecosystem moat is so perfect, then why has the market been so terrified at times? Because if you look closely, you can see some pretty serious cracks in this perfect narrative. Let's just look at the timeline. Back in May 2023, Sea absolutely shocked Wall Street by reporting that its provision for bad loans had jumped by over 120%. The stock got hammered, down almost 18% in a single day. A few months after that, a class action lawsuit pops up. Then, fast forward to early 2024, and the same thing happens again. Worries about rising credit losses send the stock diving. It really seems like the market is picking up on something hiding just behind that super low NPL number. And that lawsuit was pretty blunt about it. It alleged omissions and fraudulent misrepresentations about how the company was handling its risks. Now, these are just allegations, of course, but it just adds more fuel to that central question. Are we really getting the whole story here? Okay, so it's time for the reveal. To really solve this paradox, we have to stop looking at the market story and start digging into the accounting. And that's where we find a little mechanism we can call the write-off engine. To get what's happening, you need to know 2 key terms. First, a non-performing loan, or NPL. That's a bad loan, over 90 days late, but it is still sitting on the company's books. Now, a write-off is different. That's a bad loan that gets completely removed from the balance sheet. This little distinction, it changes everything. And this table, which comes straight from Sea's own financial filings, shows us exactly what's going on. In fiscal year 2024, the company set aside about $760 million for loans they expected to go bad. Okay, pretty normal. But then, look at that next line. They wrote off, as in completely removed from their books, over $613 million in bad loans. let that number sink in for a second. $614 million. That's how many defaulted loans just vanished from the balance sheet in 1 year. These loans never get old enough to be counted in that shiny 1.1% NPL number because they are aggressively written off and kicked out of the calculation before they can cause any trouble. But wait, there's a second force at work here, and it's called the denominator effect. Think about it. When your total loan book, the denominator in the NPL equation, is growing by 80% a year, it's getting huge, really fast. It grows so much faster than the number of bad loans, the numerator, can keep up. This crazy growth naturally pushes the NPL percentage down, essentially hiding the true quality of the loans as they get older. So, what's the verdict here? Is Sea's performance a paradox? Is it some kind of accounting magic trick? Or is it a genuinely new playbook for how to do fintech? Well, the answer takes us right back to that ecosystem. Garena, the gaming arm, is a cash printing machine that can absorb these lending losses. Shopee, the e-commerce side, brings in millions of users and all their data for free. And then Monee, the fintech part, turns those users into profits. It's this perfect triple-dip synergy that lets the company stomach loan losses that would absolutely destroy any normal standalone lender. So here's the bottom line. That 1.1% NPL isn't a paradox. It's a carefully engineered output. When you factor in those massive write-offs, you find the true net credit loss rate is actually closer to 12%. What Sea has built isn't some magical, no-risk lending business. No, it's a high-risk, high-return lending business. The real genius here isn't that they avoid defaults, it's that they've built a machine that can take a 12% hit and still be incredibly profitable. And that leaves us with the final multi-billion-dollar question. Is this a sustainable breakthrough in how to manage credit? Or is it a ticking time bomb, fueled by hypergrowth that's just waiting for the day that growth finally starts to slow down? Because the moment that denominator stops getting bigger, the true quality of that $9.2 billion loan book is finally going to come into the light.